Hi, Mark.
Hello, Dale. How are you?
Hey, buddy. Great to see you. I was watching CNBC yesterday, Mark, and they're celebrating Squawk Box's 20-year anniversary. And I thought about you coming in today, and I've been following you longer than that. And I believe that you and I have been around even longer than Squawk Box because I used to be interviewed on the Financial News Network in Santa Monica before it became CNBC, and I believe you were as well.
Yeah, this wow, it makes me feel old. But the only one who's really left is Sue Herrera.
Yeah, and you notice they moved her they moved her to the new desk, uh, tougher for women in the entertainment industry, isn't it, Mark? I mean, we could get old and gray and wrinkled and
We get
senile
experienced.
and, huh?
We get experienced.
Yeah. So great to have you with me, Mark, and all of us. And it's been kind of a range-bound euro market for a long time, and
Yeah.
bias is switching to, euro's got 120 in it. No, we're going to take out the April low. What's Marc Chandler think about this range? Is it going to continue, or are we going to have a resolution? And could part of that be with what's happening globally with China? We had our first decent sell-off in the S&Ps. What's the landscape look like to you, Mark?
Yeah. No, yeah, I think that this has been a very tough year. We had a big dollar move that basically has fizzled now, and so we have been going sideways. Uh, Take a look at the yen. I mean, I thought we were working on this big, like, symmetrical triangle, and
Right.
now we're through the apex of it, more or less.
Yes.
And so it means rather than a triangle, we're really maybe some kind of new rectangle or some kind of just continuation of this, what I think is a coil springing, excuse me, a coil like a compressing before it breaks
Okay.
out. I
Okay.
sort of think the same thing, but a less dramatic sense in the euro. We bottomed the euro back in March around 104 and some change.
Right.
And then on that Chinese news in middle of August, we got up to 117. Remember that
Yeah.
day we were
We cleaned out all the 114 bears. I thought that was going to happen. I didn't think we'd see 117 like that. But everything that's been bearish for the euro uh, really hasn't ended up being bearish for the euro.
Yeah, I don't know. I mean, I think that partly, of course, you take a look at the what happened in the DAX this year, up like 25% the first couple of months of the year, and then down 25, actually down probably closer to 30% in the after the first quarter. So I don't know. I mean, in the big picture of things, Dale, I am still unreconstructed a dollar bull. I think that
Okay.
we are. What's the driver? For me, the big driver is divergence. And so what's happened recently is some of the sort of the tail ends of the divergence story have come in a little bit.
Because
ECB,
of
DOJ.
the Fed's indecision and willingness to move.
Yep, and that's on one side. That's the Fed side. Yeah, so the Fed basically, right? People like me. I mean, I thought the Fed was going to go in June, and then what's the strange thing is, Dale. We try to learn from our experience, and so back in 2013, 2014, a lot of people were expecting the Federal Reserve to announce the tapering in September 2013, and we
Yeah.
don't get it until December. And I was one of the people who anticipated that correctly. I mean, looking at in hindsight, of course, it's good luck rather than being smart. But I just thought the Fed would want to wait, make sure everybody had it on board. But now I got caught up in it again, thinking that okay, the Fed will do it in June and then September, and I don't want to rule out December. I'm not nearly as confident, of course, as I would have been in June or September. And so that's
Well,
only the
maybe
Fed
they
side.
needed to see. We're getting a rally in Shanghai, Mark, and before this happened, Yellen mentioned we wanted to raise rates in case there's an exogenous event. I think she saw China coming, and then once we had the waterfall decline in the Shanghai index, they were worried about systemic. So maybe they are going to feel comfortable if this recovery continues in Shanghai and we get the Class A shares back above some moving averages. And you bring up December, and I think that's the craziest time to do anything. I mean, end of the year book squaring and Christmas. Will the Fed be the Grinch? Maybe they do go in December.
Yeah, I think part of the argument in favor of December is one, they have done it in December before, but the reason they would raise rates is not really so much to cool off the economy. This is why this cycle is a bit different. I think this rate hike will be the stamp of the good housekeeping, saying your economy is strong enough that the Federal Reserve judges, after being so patient for so long, and that it actually is going to raise interest rates a tiny bit. I mean, we're talking about still, we're talking about from 25 right now, 0 to 25 to 25 to 50. This is still an emergency setting for an economy. I don't know if I think of new normal, but I do think that for me as a lazy economist, two factors that tell me about GDP. Productivity growth, which is about a third of what it was prior to the crisis, which is about 0.7 now, the last 4 quarters, and labor force growth. And we know from that participation rate, we know the labor force isn't growing. And so I think that this means that we should expect slower growth. I mean, how slow growth? I think anything above 2% should be regarded as above trend. And that means
the new normal. The new normal.
Yeah, I mean, I'm hesitant to call it the new normal because there's a lot of baggage attached to that. But I think until one of these two things changes, either productivity increases or until growth, until labor force increases, and my bet would be on productivity comes first. But until this happens, it's hard to be very optimistic about something going back to 3%. But what this means, though, is the Federal Reserve can feel comfortable raising interest rates if they think growth is only going to be 2%.
And you're right. That would be a stamp of approval that finally, after all this time, the Fed has confidence to go ahead for the liftoff. Mark, I think I think they want to do it so they have tools in case we have some kind of meltdown globally. And growth, don't you?
I agree with you. I think this is an important thing about way decision makers. But I mean decision makers. I don't mean like people like me, but I mean people in real power positions, managing either lots of money or managing a lot of power, like politicians. There are a couple of things that they want to do. One is to maximize their options. And right now, monetary policy, conventional tools are not available to the Federal Reserve because they cannot cut them, like you say, if there was going to be an economic downturn. Secondly, they want to wait to the last possible minute to make a decision. And that's because you, as a decision maker, you want to be able to have the information set will never be complete. Even as traders, we know that. But you want to have more stuff as possible into that information set, which means making the decision only when you have to. And thirdly, I think it's about credibility. You want credibility, say what you're going to do and do it. And I think the Federal Reserve, they've shown some flexibility here. They said, look, the facts on the ground may be changing. We'll wait a little bit longer. And so we'll have to see what happens in December. I don't know how far they can stretch that out before they really do lose credibility. But so far, I think they're being prudent.
Okay, well, I want to switch gears a little bit because everyone is so focused on the Fed that I think that they might be missing what's happening politically that could have major impact on our markets. Now, I know we've dodged the bullet so many times on the debt ceiling, but I was talking last week with Boehner retiring, and then McCarthy was put his foot in his mouth, and the disarray that potentially this time, that in November there could be an issue about the debt ceiling, and that's going to overshadow anything that central banks can do in the markets if that happens. Do you think there's a possibility that these, I think Freedom Caucus is the label they've chosen, can take us to the brink and pass it maybe for, a week or so, that we're technically in default, and that's going to be a major market volatility factor, I think, if it comes in.
Yeah, no, I think you're right. I'd say, in my experience, I would say that our ability as a species, let alone just being Americans, our ability to shoot ourselves in the foot knows no bounds.
Yeah.
And so, yes, Congress could do that. I would still place the odds, especially ahead of a presidential election year, despite the disarray. I still put the odds at pretty low that push comes to shove and the U.S. would really default on its debt. I think that would be a major market event. I do think, though, that closure of the government alone might be an impact on the Fed's decision.
Yes.
So, because they're going to be meeting in the middle of December, and it's theoretically possible, at least, that the government's closed, which means I think that they could not really change policy. They could technically or legally, but I think they'd be hesitant to change it when the closure's there.
Yeah, maybe just they go past. I mean, what's going to be the repercussions? Let's say they don't get it done by the deadline. I think it's November 4th, 5th, something in there, and we're in technical default for a day to a week. The impact on the markets for a week, I think, is going to be dramatic. But perhaps then they come together when, just like when they didn't pass TARP the first time, Mark. You know, the market was selling off on that no vote, and then Congress saw what was happening to the economy and then finally passed it. Do you remember that?
Sure. I mean, it's possible that we have some event like that. I would still, in my own like very subjective like analysis, I'd have it as just as a risk we have to be aware of. But I'd say, and it's one of those risks that are might be a low risk, a low probability, but of course a high impact. So we want to be particularly sensitive to those. A lot of people confuse those, I think, with black swans. I mean, but we know that this is a possibility. So it's hardly coming out of the blue. But I still think it's especially given the presidential election and the national elections we have next year, that I
Right.
think Congress would be loath to do that. Some kind of another effort to essentially kick the can down the road further.
Okay, well, since we talked, we had this huge bear market in commodities, oil really being the start to the downside. Uh, Nice recovery, almost momentous recovery we've had in the past couple months, and now we're fading. Gold shares have been on the move from last Friday's NFP. The gold rally about 50, 60 bucks. If I'm reading you correctly, and you think there's going to be another bull move in the dollar, which I think maybe the dollar goes to 89 or 90, the Dixie, before the dollar regroups. It's starting to look heavy. I have 94.5 as being kind of a line in the sand for the bull case on my daily charts, and we're testing it here. What's your take on what's happening in commodities and commodity currencies? Do you think that the worst is behind us in the commodity bear market, and that we're now entering a basing period of stability there?
Yeah, no, I wish that was going to be the case. But here's what scares me is that I don't think that there's been the capitulation trade yet. I mean, look at the oil futures. The speculators have been net long throughout this whole down move.
Right.
And I think that more people, I saw one of the large mutual funds quoted on Bloomberg last week saying buying emerging markets was a buy of a decade or a buy of some period of time. And I just think that we're in a bear market for emerging markets and for commodities, and that those moves tend to go well beyond and last longer than we think. And so I think sometimes these tradable bounces. I mean, it really depends, I think, on people's time frames. I don't think that, I mean, I work mostly on the institutional side, and it's hard to have a trade idea that's for everybody, regardless of risk appetites, regardless of whether they're the large stack or the small stack, whether they're playing for volatility, direction. There's a lot of complications in this, but in general, I'd say we're in a bear market for currencies, emerging market currencies, a bear market for commodities, and I don't really see these retracements yet. I was looking at like the in the major currencies, Canada, Aussie, Kiwi, and these retracements are just we're turning here, we're stalling here near some important retracement levels in those currencies. I think that we came down so far so fast, and part of it that coming down was on ideas that the Federal Reserve would raise interest rates, and it was partly predicated, I think, on stronger growth that the IMF and the World Bank and everybody and their mother keeps revising lower.
Okay, so it reminds me, people want to buy things that are cheap. I'm echoing. But when you buy something at a Target that's cheap or some other dollar store, what happens? It's cheap, it breaks. So maybe that's what we have here.
Yeah, and I think that you made an interesting idea too, Dale. I think is that what we're taught in economics classes is the lower the price for something, it should increase the demand for it. But I think that in the financial markets we see it's completely different. I suspect, for example, there'd be more demand if U.S. T-bill yields were up to say 10 or 15 basis points, as opposed to being in negative territory. And that is to say that it's really I think about the demand for money. It doesn't always respond to low interest rates, low nominal interest rates. And so I think that for me one of the lessons in the markets is that the low price of something doesn't always increase the demand of it. And the other thing I'd say too about this is that um, we have to keep our ideas as hypotheses. So even if we're looking for a bottom or a top in the emerging market currencies or commodities, the key, it seems to me, people who make money in the markets aren't right more often. They're just better managers, better disciplined risk managers than those than other people. And so that's the key thing to keep in mind. That of course we get tempted at picking tops and bottoms, but it requires being very disciplined about our stops.
Yes. So you mainly advise on the institutional side. You're willing to share what your views and what you're sharing with your institutional clients about positioning here in the market?
Well, I think what we've seen a lot of the real money accounts do, I mean, as they've been getting some cash, as people have been cashing out, redeeming stock, what we have seen, though, is the U.S. money, almost dollar for dollar, especially in the first half of the year, going to European stocks.
Yeah.
A lot of our clients are, they get evaluated relative to key benchmarks. Maybe it's the Morgan Stanley MSCI indexes or the S&P 500. And so it's been a very difficult year for many of them, and the low interest rates, of course, doesn't help either. And so I think it's been a tough year.
Yeah, we have hedge fund legends closing down hedge funds. So the hedge funds, even the pros, I think it's important you bring up a great point that retail traders should keep in mind that these guys that are closing up shops and hedge funds would do cartwheels for a 25% annual return on their money. And, people buy these, 3-figure, 4-figure returns in FX. I wrote a song, Use Less Leverage when you trade the markets. And so even the pros, and these are guys that have been so successful, go through drawdown periods. And they'd be really celebrating and popping champagne bottles if they were up 25% on the year. Like a lot of retail traders are not satisfied with that.
Yeah, I think it's for me, I think this has been this year, last year, very difficult markets. I think the microstructure of the market is changing as far as like institutions, relative high frequency traders. I think there's a bit of an arms race about algos, artificial intelligence. I think you've got large pools of capital, and I think myself, when I try to trade as a retail investor, I know that I've got the short stack at the Texas Hold'em table. That there's bigger pools of money that can use options, other derivatives to protect themselves. They can have different time frames. So I think that the structure of the market's changing. It has changed, and we have to keep our trading techniques up to date to make sure they still work. For example, I used many years ago when the dollar index was first being launched. I was working at Dean Witter back in those days, and on the retail side, and I was
in Sears.
They've been spun off from Sears. But yeah, stocks and socks, huh? But launched the dollar index, and I used some of their tools. It was at New York Cotton Exchange at the time, and I used some moving average optimizers that I use to this day, the 5-day and the 20-day moving averages. And it is true that you can get whipsawed, depending on what kind of market you're in, really. But for a trending market, it does a fair job to help me identify the underlying trend. But to tell you the truth, I mean, these tools may or may not work as the microstructure of the market, high frequency trading, less corporations, maybe with different liquidity measures. The day that the Swiss lifted its cap on the currencies, on the franc back in the middle of January, daily turnover that day is estimated to be about $10 trillion.
Wow.
It's about twice what it usually runs, and yet that $10 trillion, people were still, participants were still upset by the lack of liquidity in Euro Swiss. Right, a small order, and you had a very wide spread between the bid and the offer, and so we shouldn't confuse volume with liquidity, and I think that these kind of things make it more difficult to trade, and why we've got to keep updating our techniques.
Okay, are there any geo spots that you take into consideration with what's happening in Syria now, with Russia being involved and the Chinese sending aircraft carriers to support the Russians? To me, it looks like the alliance is China, Russia, Iran, and we have really created or there's a vacuum there that Putin has decided to press his advantage and move into that. Are there any geo things? A lot of guys have bright minds, talk about war cycles that are beginning to develop. They're also talking about some very difficult times ahead in the world, Mark, over the next 4 to 5 years, with potential for sovereign debt crises. And I do not like to talk about it. I hope they're wrong, but there are a lot of things I'm seeing. And you talk about liquidity issues in the market that first started in the bond pit. When I was in Chicago, there was barely a tick between the trades in the bond pit. And then when we had the flash crash again in the S&Ps for it to open 1,000 lower, they couldn't open things for a while. The way the structure is changing, is it making it more vulnerable to some type of crisis erupting because of that?
The Economist had this article, I think in the magazine section about 2 weeks ago. It talked about like this hegemonic crisis, that the U.S. was no longer able to devise fair rules for the game, international rules of engagement, so to speak, and but no other country, every other possible candidate was also terribly flawed. And so we're sort of left in this bit of a, in some ways, they would want to argue a decline in the U.S., and no one could fill that vacuum yet. I tend to think a lot of this stuff is exaggerated. I think that even now, I think people beating us, whoever us really is, like U.S., in the Ukraine and in Syria, and how he's extending his power and influence. And I think that this is a very short-sighted. Whether you look at a lot of the wars that the U.S. has fought, like the Civil War, or World War II, World War I, the eventual winners of all three of those wars was not immediately obvious. And the same thing now. People are I think, are being short-sighted, thinking that Russia has really gotten some big advantage. One of the reasons why I believe that the U.S. did not put boots on the ground in Syria is because it was going to be a quagmire. And so Russia steps in that quagmire, and we should be all like worried that Russia has done something really bold here. I think that we're going to see. For me, the political thing that's going to happen, one of the things as a fallout, is that two countries in particular in Europe are not members of NATO, and yet they could join NATO in the next few years. And there I think about Finland and Sweden. Russia's been harassing them,
yeah.
And they joining NATO does that mean that the U.S. has won something? No, but it just means that the cost of Putin's actions are not so victorious and triumphant as many of the critics both in the U.S. and outside the U.S. want to say. I think they will see, for example, here's something else happening. Poland just signed, and they'll make it official, I think, later this week, just signed a pipeline deal with the Baltics, which will help free the Baltics up from having to be dependent on Russian energy. And this includes the antitrust suit against Gazprom that help break that up a bit as well. And so I think this is a long game, and I won't want to make a decision based on 2 years of activities or a couple of weeks of Russia taking a more active role in Syria.
Yeah, I hope that history doesn't repeat, because their first quagmire that took down the USSR was Afghanistan. And then we followed some years later. And you brought up World War I and II. World War I and II was underway for several years before the U.S. got involved. So we're always have to be dragged in kicking and screaming into these type of conflicts. So actually, perhaps that's the cycle this time. It's going to take something very dramatic for us to get involved in Syria. What do you think about what's happening with guys like Donald Trump and Ben Carson, and tonight we have the Democratic debate tonight? Mark, do you think there's anything to be said about the rise of far left Bernie Sanders and far right wing freedom parties, Donald Trump, Ben Carson, that we've become so polarized that if we don't have a mainstream candidate victory, that either way it's going to create a lot of uncertainty for the U.S. if we have a Bernie Sanders or we have a Donald Trump? And how do you think this is shaping up? We're a little over a year away from this event.
Yeah, I mean, on one hand, I think that what we're experiencing in the U.S. is very similar, I think, to a broad sweep across the high-income countries, and that is that on that somehow, maybe it's because of the crisis itself, maybe it's because of the response to the crisis, but people around in these high-income countries are not happy with their political elites, let alone the economic elites. And so I think that you see these outsiders. Look what the Labour Party in the UK recently did. And not an outsider, but someone from outside, say, the mainstream of the dialogue. And so I think that the same thing's happening in the U.S. For various reasons, we're not happy with the with the political elites, and we're looking for alternatives. And I think that's the only reason that I can understand why some of the candidates are drawing the kind of support they are. I think that the center has shown itself to be. I mean, look what's happened. I mean, the financial crisis with our leaders. I mean, part of it is the whatever you think the causes are. I think most people would agree that the political leaders dropped the ball to some extent, and that the ongoing divergence, disparity of income and wealth, not just in the United
Yes.
States, these are throughout. And I think that this is a political pushback, a blowback to the loss of credibility of our elites. I mean, the Volkswagen story doesn't impact the U.S. perhaps very much immediately, but I think there's just another example of the elites being shown to have clay feet, to be caught, whether it's the banks in the U.S. or Europe, consistently being caught with their hands in the cookie jar, violating rules, consistently getting fined. Whether it's the corporations, the disparity of wealth. I think all these issues make people want to push back against the elites and are looking for an alternative. But I think that they're still very divided, and there's not a clear, compelling alternative.
Okay, and so Shakespeare said, Mark, and goes to what you said, that when the coffers are full, people cry out for democracy, and when they're empty, they cry out for a great leader, dictator type. So that kind of seems like the way we're going. Nationalism on the rise, socialism on the rise, kind of looks like the 30s to me.
Yeah, and so and that's the other point about the 30s, of course, is that when we had floating exchange rates before, that experiment didn't lead to very good things, and which is why one of the reasons why I think the TPP that was recently at least formally agreed at. Now we need the countries to ratify it, putting trade back under the center of the story, so that we don't begin to have some kind of creeping protectionism and lead us the other direction.
I tell you what, Mark, it's really been great talking to you. You know what is great about talking to you? I could bring up anything, and you're there with thoughtful responses. We were all over the map. I encourage people to follow Mark's work at Mark Making Sense on Twitter. You have anything else going that you'd like the public to know about, Mark?
I appreciate that. A plug for my blog called Mark to Market. That's M-A-R-C, makes my mom happy, marktomarket.com. And I put the stuff, not only my stuff for the bank that I write for institutional clients, but occasionally I'll put some commentary up on emerging markets from my other colleagues. Again, this is institutional research that we can make public because of the rules of the bank.
A giving spirit by the banks, and a giving spirit from you, Mark, for joining us today. Really enjoyed talking to you, Mark. It's hanging out with you is always compelling and also fun. So thank you so much, Mark. I hope you have a great fall trading season. Let's get back together in the winter and see how this great divide is, either the chasm is widening. And also, thank you for your optimistic view, counterpoint to a lot of the crisis-type thinkers out there, that we should take a long view, and the long view is you still think that humanity will reign.
I hope so.
All right, partner. Good hunting, Mark. Thank you very much. My trading warrior brother, Marc Chandler at Mark Making Sense. Mark on the Market. Go to Mark's blog. You'll be edified. Thank you, buddy.
Thank you.